everyone, and welcome to an exclusive conversation with Mr. Prashant Jain, Chief Investment Officer and Fund Manager at HDFC Asset Management Company. On today's webinar, we will be answering the big questions of how to ride the ups and downs of the current volatile markets with the final conclusion of what lies ahead with a prudent solution from the expert himself. Hosting this conversation is our very own Mr. Himanshu Joshi, Head of our Select Pan-India Branch Network at ICICI Securities Limited. So let's get ready for some exciting exchange between two stalwarts of the mutual fund industry, brought together just for you. We hope you take away the most. Over to you, Mr. Himanshu Joshi.
Thank you. Thank you very much. Hi, Prashant. Great having you on board.
Hi, Himanshu. Good afternoon.
Good afternoon. For sure, let us start with the first, query or doubt which customers would be having in their mind. We couldn't have asked for a more volatile kind of a year, considering that we were coming out of Omicron and that was tapering a bit. And then we had Fed also, tantrums which we had already expected. That also was trying to play out. And then we did not require a geopolitical impact which came from Ukraine and Russia. So how do you think this is going to impact the markets in the medium term to long term?
Himanshu, that's a very topical issue that you have raised, and I think it is also a good illustration of why equities are always considered to be risky and uncertain in the short term. And when people say, what are the risks that you see? I mean, I often say that the real risks are not known. What has happened in last few days, I think, highlights that once again. I think, clearly what is happening is not positive for the markets, because markets hate uncertainty. And the key issue is, how does this issue resolve itself? How long does it take? What kind of sanctions are imposed? And I don't think we have clear answers to any of these issues. As far as the impact on the economy is concerned, I think it would vary significantly from country to country. And it would also vary significantly across sectors. We have seen significant inflation, increase in energy prices, coming on the back of underinvestment in this space over the last several years. While it will be positive for sectors, the energy sector, and for countries that are exporters of energy, it will be negative for sectors that use energy and for countries which are net energy importers.
Right. So talking about the impact of this geopolitical crisis on the energy sector, one of the biggest factors it impacts is the oil prices. And countries like India and China are like huge guzzlers of these fuel-driven. They are basically a fuel-driven economy. We were expecting that the fuel or the oil to cross $100 kind of a per barrel, but it is surprising that it is almost touching around 110, 114 kind of a thing. How do you think it will impact the trade deficit going on a medium-term kind of a situation for India?
Well, clearly, this is not positive for India. And India, around $70 of oil, I think our energy imports, net energy imports are about 3% of GDP. Roughly a 50% increase from those levels means that will go up by around 1%, which is a negative, but I think we should be able to handle this reasonably well. If you recollect, way back in 2008, oil had crossed $100 and we did reasonably well. It put some stress. I think the large and growing exports of the IT sector and good foreign exchange reserves and the very low cost of capital that is prevailing outside India, I think are mitigants. We should be able to handle it, though clearly it would lead to some stress on the current account, some stress on currency, and consequently some stress on the inflation.
Okay, that is interesting. So if we come back to the markets, out of these three major factors which are playing out in the macroeconomic thing, like the US interest rate hike, your oil price hike, and also the geopolitical turmoil in the Balkans. Which do you think would be the most thing which will be impacting the Indian markets the most, and in the short term and the long term?
Himanshu, while clearly in the short term, the course of this conflict will be at the top of everyone's mind. But I think if you think few weeks, few months, then this conflict should end. Uh, with what outcomes we don't know, but it should end. Typically, these conflicts don't last very long. And I think what kind of sanctions are imposed ultimately, especially around the energy space, if at all any, I think that will also have some bearing on the energy prices in the medium term. I think what happens to Iranian oil is also a variable that we need to consider. I think in my best guess is that in few months' time or few weeks' time, focus will once again come back to the US Fed, because ultimately the cost of capital, the global cost of capital, is the most important variable. What is happening currently is extremely unfortunate. It will create a lot of pain for lots of people. But I think this will pass, and ultimately the most important variable I think for our markets going forward would once again be how US Fed behaves and how do US Treasury yields.
Right. Prashant, now since we are in Q4 and all the eyes would be, looking forward as to what would be the results coming through in the last quarter of this financial year. Considering that this was, this last 2 years had been a lot of, I would say, challenges which came across to the corporate world. But during course, I think we learned also, and there were a lot of tightening and innovation and a lot of efficiencies which are created in the corporate world. So keeping that in mind, how do you think that the Q4 results will be panning out to the large players or the large sectors? Do we see any green shoots or upside in this in Q4? Should we be optimistic about it?
Sure, I think the outlook is mixed. The impact is mixed of what is happening currently. Fortunately, India has clearly come out of the NPA cycle. And therefore, the bank balance sheets are extremely healthy. The provisioning costs are likely to be extremely low going forward. So I think to that extent, this very large sector of Nifty, the outlook is quite good. The only challenging piece here is that the credit growth in India continues to remain weak. We are optimistic about the future, but at least for now, the credit growth remains weak. And as and when that picks up, either driven by revival of private capex or higher inflation, I think it would be good for this very large sector. The current environment clearly is extremely positive for all the commodity companies, the global commodities, the metals and the energy companies, because these prices have gone up very sharply. And the key is, where do these prices settle once the current conflict is behind us? I don't think we have clear answers to that, because as we have been highlighting for last couple of years, the world has underinvested in the energy space, driven by ESG concerns. And these concerns are impacting the supply side more than the demand side. And therefore, only time will give us the right answer as to at what level energy prices sustain. But clearly, the higher they sustain, the more better it will be for that energy space. On the flip side, I mean, the users of commodities, whether it is automobile companies, cement companies, anyone that is using energy or metals, I think would be adversely impacted in the near term. Even the consumer staple companies would be adversely impacted. Over time, we have seen time and again that with some lag, these costs do get passed on to the end consumer. I think clearly near term there could be some pressures on earnings of commodity users, but I don't think these pressures would last beyond few quarters.
Thanks, Prashant. So considering the fact that we were having almost a daily basis rally in the markets. There is a time which is coming where we are seeing the FIIs being net sellers in the market, and they play an important role as to how the market behaves. So, what is your view on the medium term as far as the FIIs' impact on our market is concerned?
So clearly, Manchu, FIIs are very large players in Indian markets, and in the past, we have seen that whenever FIIs sold meaningfully, markets corrected. And interesting to note that they've been investing in Indian markets for almost 30 years now. And in all but 4 years, I think they've been net buyers. I think given the growth prospects, the size, the diversified nature of Indian markets, one should be optimistic about positive FII flows in the medium term, though it's very hard to say when exactly this current phase of selling would stop. What is interesting about this FII selling phase is that for the first time in my career of almost 30 years, uh, we have seen the markets hold up extremely well despite significant FII selling. On similar occurrences in the past, we would see the markets fall off very sharply. I think that's a very good development because the local flows into equities in India, both through institutions, mutual funds, insurance companies, and direct flows, I think are extremely healthy and they are a very strong counterbalancing force. And I think uh, if this trend sustains and going forward, the very high volatility that we have experienced in the past in Indian markets driven by FII flows would reduce. And to that extent, I think equities will become probably a slightly less volatile asset class going forward.
Okay, great. So since we are here in terms of talking about equities, I think it is important that we also take a sense of an investor, a retail investor, and as a retail investor, uh, what is your view or advice to him in terms of a near-term market risk which he should consider or factor in as he's looking at a long-term financial goal achievement? So what could be the near-term risks to the market which he should be aware of? So, and he should not be, unnecessarily ruffled by the fact that near-term volatility could be there. So what do you see the near-term risks in the market?
Manchu, my honest answer is that no matter what kind of analysis we do, what kind of risks we identify, what kind of scenarios we plot, fact is that in the short to medium term, markets are extremely hard to forecast. And that is time and again what is reinforced by the way markets behave. I mean, risks could be outcomes of state elections, it could be sustained high oil prices, it could be high inflation, higher than expected Fed interest rate increases, it could be, more sanctions in the world, more turmoil. So, I mean, risk could come from all directions. What I have experienced over time, however, is that returns are very nicely correlated with the valuations prevailing at the time of investments. And because over time, these risks tend to not impact the markets much, and returns are a function of the starting valuations. And when I look at that, I think there is reason to be, cautious on the markets. And given the way where valuations are, India's market cap to GDP, P multiples are marginally above long-term averages. The cost of capital globally is very low, will go up over time. I think keeping these in mind, we should keep moderate expectations from markets and we should invest only that portion of wealth in equities which we don't need for 3 5 years. I think we should avoid borrowings, we should avoid leverage in these markets, we should be prepared for volatility. But at the same time, given the secular growth nature of Indian markets, of Indian economy, I think over time equities should continue to outperform also reasonable.
Great. So for a customer who's got an investable surplus in this kind of a market, and he wants to view this as an opportunity, what would you advise in terms of his expectations on a medium term to long term for his investments. So we have customers who believe that they have the investable surplus and they require an answer as to what should be their horizon and what should be the a reasonable return they should be expecting on a medium term to long term.
Himanshu, I mean, in India, equities have been compounding around nominal GDP growth rates 12-14% a year over long periods. And Sensex started at 100 and we know where it is. So it's a great compounding machine over 30, 40 years, 10, 20 years. I think the key is to invest in equities, to my mind, only with a long-term view, because it is over long periods that the risk in equities reduces. Having said that, these are not markets that are cheap. So clearly there is a need to moderate our return expectations. I would suggest to clients they should not extrapolate the high returns of the last few years into the future, because that was largely a result of the very low levels of the markets that prevailed. And one should focus on risk, reduce risk in portfolios, invest where you understand, and also keep a sharp eye on valuations and net. I think one should keep moderate expectations about returns over the medium term.
Expectation having addressed, I think one of the most important thing which a customer asks us also is that what should be my investment strategy in terms of how do I minimize and mitigate the risk which could arise out of this kind of a market. So for a basic customer who's basically looking at long-term financial goal achievement and a medium-term financial goal achievement, what kind of instruments would you suggest him in terms of investing so that it mitigates or reduces the risk of the volatility of the market?
Himanshu, I think if you try to eliminate volatility or reduce volatility from equity portfolios, it will take away virtually your entire returns. I mean, the cost of buying a put on a monthly basis will take away your entire long-term returns, and you don't know which month the markets will fall. Therefore, I think, to my mind, it is most profitable to run unhedged portfolios over long periods, be tolerant to short-term volatility. And that's why I once again reiterate that one should invest only that much money in equities, either through funds or directly, which one can handle volatility on, which you can hold for long periods. And I think that's probably the only sensible way, at least that I'm aware of, to generate reasonable long-term return.
Great. So Prashant, I think it was really great and enriching to engage with you.
Wow, that was absolutely insightful. Now that we know what the expert has to say, we hope that you make the best use of it. To know more, visit our ICICIdirect platform or simply call your RM or visit our near branches. I would like to give a vote of thanks to Mr. Prashant Jain and Mr. Himanshu Joshi for sparing their valuable time. And last but not the least, my immense gratitude towards our viewers for making our webinar even bigger than ever by gracing it with their presence. Please don't forget to like and follow our channel for such more updates. And please feel free to give your suggestion in the comment section below. Have a wonderful evening ahead and stay blessed. Goodbye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.